beginning this show with some breaking news that we're running this hour. Well, the International Monetary Fund has increased the global GDP growth forecast by 10 basis points for this year. The forecast for 2024 stays unchanged at 3.2%. In fact, for India, the International Financial Agency has increased the GDP forecast for 2024 to 6.8%. On the inflation front, IMF expects it to cool from 5.4% in FY24 to 4.6% in FY25. And to discuss the implications of what the IMF has to say as far as global growth is concerned and India's growth in particular is concerned, we're now joined by Madhavi Arora, who's the lead economist at Emkay Global, on the phone line. Thanks very much, Madhavi, for joining us this evening. I want to first understand what really could be attributed to this strength that the Indian economy is showing once again as bright spot as far as the global GDP growth is concerned. And secondly, which sectors do you think will drive this growth forward?
So basically, the IMF has been a bit of a laggard in terms of acknowledging, India's strength. And most of us also sort of underestimated the growth, prints that we ended up seeing through the year. But that said, of course, the healthy print that we're seeing on the GDP front, obviously, is a little overstated. Partly on account of the fact that, we deflated issue, which tends to sort of overstate at a time when we have lower, PPIs or the WPI inflation. But at the same time, a big wedge between value added and, the GDP at market price has also been very high, which basically makes the GDP numbers look very bloated, around 8%. Against that, you are slowing to a 6.5% or 6.4% IMF puts it, is actually a slower number than what the Reserve Bank is also looking at. So that said, of course, the print is very healthy, given the fact that we have seen massive monetary tightening across the world and back home as well. But domestically, I think last 1 year has seen basically a big catch-up, which has been done by the manufacturing sector versus FY23, which I think will continue next year as well. So in FY24, manufacturing probably would have grown close to 8.5% plus. And I think next year also, despite the decently healthy growth that we saw in FY24, F25 would also see close to around 6% kind of print on the manufacturing bit. Last year, which is FY24, we also had a benefit of, higher margin because the input costs on a year-on-year basis were relatively lower because the commodity prices for most part of the year were relatively muted compared to FY23. So we enjoyed that benefit as well in terms of the value-added gains in the manufacturing bit, which probably could fade as we get into FY25, and thus we are seeing a much lower growth versus FY24, which could even track close to 8% GDP growth. Against that, a 6.5 or a tad lower is actually a decent moderation. And also, I think FY25 will see a relatively lesser spending by the government as well versus FY24. And as I said, probably the lower commodity prices, which were benefiting us in FY24, would be taken away. Against that, of course, is a slower growth story, not a stronger growth story. But that said, the fundamentals of the growth bit is still very strong, and the breakup of manufacturing and services both are looking to be stronger than what initially envisaged.
Yes, Madhavi. So you're stating that this is a healthy print, and of course, in light of the growth figures that IMF has mentioned as far as the overall global growth is concerned, and of course, especially the China factor, it categorically states that India maintains its position as the fastest growing economy, surpassing China's growth projection of 4.6% during the same period. Now, the number for the GDP growth number for for 2025 has been moderated a bit to 6.5%. What really are the challenges that really lie ahead as far as global economy are concerned, and how is India going to get impacted due to them?
So again, as I said, that the world still hasn't seen the full impact of the monetary transmission of the last hikes that most of the developed markets have seen, and most likely you will see developed markets also slowing in second half of the year. Probably we are getting into a situation where the soft landing scenario is looking to be more probable case in the world, which means that the growth hit may not be very, very material. But at the same time, that will also mean the policymakers will not necessarily cut rates, which means that you are going to be in a situation where you have higher for longer, plus maybe relatively slower growth, but not a crash in global growth. So that should, obviously at the margin, impact our exports to some extent. But at the same time, domestically also, we will be seeing a slower growth in our domestic demand to some extent, and that obviously would also imply that our imports could also be lower to some extent. But I think the direct impact for us when it comes to global growth story is one, through exports channel, which is a trade channel, and two, through the financial channel, which will impact the currency and your other asset classes in the financial sector. So that, I think, if there's not a crash in the global growth story, those do not necessarily get too volatile or too perturbed. But from the growth channel directly, you will see a hit in terms of trade if there's a material growth slowdown you see globally.
Right. So you basically mean to say that there is caution as far as the global growth story is concerned. I want to also bring in the China factor, which is also slowing. And, the IMF projects it to grow anywhere. 4.6% during the same period, which it has stated for India, 2024, 2025. I want to understand the kind of, positive bearing then it will have on India in terms of investments coming in.
We'll have to see how China Plus One plays out. At this point in time, we're a very, very marginal player in the global manufacturing value add. To the extent that China is almost 16% plus of the global manufacturing value add in the world order, while we are probably less than 1.5%. So I think we haven't necessarily gained materially from the China Plus One strategy as such. Of course, handful sectors like automobiles or even electronics have gained at the margin. But I think we are far away from that situation where 1 year change in the China's growth story could really lead to a big investment back home because of that. Because the big gainers of China Plus One have necessarily been other Southeast Asian countries, to be very honest. That said, of course, at the margin we also benefit from that. But at the same time, we need to see how China growth story slowdown is actually playing out, because China is also strategizing itself to become a manufacturing hub of a different order, wherein it's keeping its relevance continued even with the slower growth that you may see on papers. So I think the China underwhelmed growth story has to be seen with caution, and also to be understood, China also is revamping its growth model materially, which means that our strategies also have to evolve according to China's growth strategy plan.
Absolutely. Thank you very much, Madhavi, for joining in with your perspective on this crucial story. So Madhavi over there stating that, while the China growth story is slowing down, we'll of course have to be cautious because, that's not going to remain so for a long period of time. Again, this is something that we'll be watching out for and tracking very closely.
If you like this video, then like, share and subscribe to ET Now.